On a monthly basis in the month of March. It was slightly higher than what the street had been expecting. Another sign that the economy remains resilient, even with stubbornly high inflation. Recent data is causing economists to reconsider their forecast for the Fed. Our next guest recently pushing his rate cut outlook, now expecting the first cut not to come until December. We've got Matthew Lazzetti, Deutsche Bank's chief U.S. economist, here on set with us. Matt, it's great to see you.
Good to be here.
So talk to us just about the recalibration and why you don't see the Fed cutting now until December.
Yeah, so our reassessment came after the latest CPI report, but it was not just about that single report. What we've seen is 3 straight stronger than expected inflation prints. Most important for the Fed is what happens with inflation and whether or not they have confidence on disinflation. But it's coupled with very resilient labor market data, very resilient GDP data, as you kind of mentioned. You know, the labor market reports have been producing more than 200,000 jobs per month on average. Equity markets are buoyant. Financial conditions have been quite easy. So all these things together, I think, has caused us to reassess when the Fed is likely to cut rates, and I think we're hearing more hawkish signals from the Fed as a result of that as well.
If we get too close to the election, and your first cut that you're pricing in as well, December, so after the election here, which would satisfy the Fed's desire to look apolitical, but at the end of the day, there was a lot of conversation coming into whether or not they should or could cut if things got dire enough going into an election. What do you think the calculus would be there?
Yeah, I think first and foremost, if the data are making a clear case for cutting rates or raising rates, for example, the Fed would do so.
A raise? Do you think they could still raise?
I don't think that they would, but I think if you were to see this big acceleration in the inflation data, more likely would be that they cut rates. But if it's a clear case, probably driven by a weakening labor market and growth data, they could cut rates around the election. I think it's more complicated if it's just about inflation. The Fed is thinking about cutting rates because of disinflation, but inflation is still well above the Fed's target. And so cutting rates for the first time just based on inflation right around the election, I think is more complicated.
What do you think the path looks like ahead for inflation? Could we trend higher? Is it more likely we're going to trend sideways? What do you think that movement's going to look like over the next couple of months?
Yeah, so our forecast for core PCE at the end of this year is 2.7%. We think on Friday it's going to show 2.8%. So mostly sideways from here. I think you're going to have certainly gyrations within that. We have a lot of base effects that will influence things. In the near term, over the next several months, I would expect that you see inflation decelerating a little bit, but actually then reaccelerating over the back half of the year.
What is the wage kind of input of data that we're going to be receiving next week? What does that signal for the inflationary picture that the Fed's going to be jousting?
We'll get the employment cost index, which is really important. If you look back at the Fed and when Janet Yellen was the chair, she would often reference the employment cost index as the best indicator for wage growth. I think what you see from broad-based measures of wage growth is continued deceleration. I think what you see from leading indicators, the best one is the quits rate. The quits rate is at the lowest level since 2018, essentially. It's showing that wage growth should continue to decelerate. From my perspective, the labor market at the moment and wage growth at the moment is not an additional reason for the Fed to be hawkish, but the inflation data certainly is.
Matt, I'm curious, when you take a look at some of the data that we've gotten out most recently, and going back to yesterday's print on PMI, it did show some weakening when it comes to labor. It did show a decline here in manufacturing. It is just one print, but is that a signal that maybe the economy isn't as strong as some of these other data points have pointed to in recent weeks?
Yeah, you've gotten, over the past year, some head fakes, I would say, from these survey-based indicators, especially the ISM Services Employment Index actually collapsed last year and then completely reversed in a given month. And really, drove a short-term move in markets. I think really until you begin to see that soft data, the survey data, filter through into weaker hard data, it's really hard for the Fed or anybody to respond to that. Yes, it was a weaker employment component, but we've been seeing over 200,000 jobs per month on average. The unemployment rate is near historically low levels. There's no really other indicators that are telling us that the labor market is falling apart at the moment.
The Fed stuck on transitory for too long previously. Is there a risk that they could stick on higher for longer for too long?
Certainly it's a risk. I think that they've been talking about risks coming into better balanced, but they were talking about that at a time where they thought disinflation was very clear. I think when we hear from Chair Powell next week, he will continue some of the recent language that we've heard from Fed officials, which is, if you look at the economy, there's just no urgency to cut rates. Growth looks fine. The labor market looks very resilient. Inflation has some upside risks. But they are kind of cautious about the idea that, yes, if you hold for too long, what looks like a soft landing today could be jeopardized. So that risk is no doubt out there. The task for them is trying to balance those risks as we look ahead.
Do you think it's most likely we will see that soft landing scenario, it sounds like?
We do. I mean, we do think that you get a soft landing. I would say, though, that the higher inflation is, the longer that it's higher, the more that pushes the Fed to maintain a restrictive stance, and the greater the risks are.
Right.
So those risks have risen over the past several months.
Matthew Luzetti, who is the Deutsche Bank U.S. Chief Economist. Thanks so much for joining us here today. Appreciate it.
Thanks for having me.
Thank you.